why are we investing in online and technology stocks? The reason is basically that as a sector, it's outperformed everything else over the past 2 decades. Whether you want to measure it on 5 years, 10 years, 20 years, that the online marketplace and technology stocks have outperformed. This little chart here just shows you just the level of outperformance of this stock. I'm not saying that this is going to happen for you again, but certainly I am very confident that particularly the larger of the online and technology stocks will continue to outperform the market in general. There's a lot more growth left in them. Just looking at the biggest of the lot, REA Group. We all know that the property market, the residential property market's depressed. It's slumping. New listings volumes measured by REA are at a 40-year low. Why would we be buying a real estate advertising platform at a 40-year low? The reason is that there is you're getting price rises and mix shift to premium ads. So that's enable them to overcome the drop in volumes, and it's going to deliver 13 to 14% revenue growth. We're expecting around about 14.6% revenue growth for the half and 24% underlying NPAT growth. So this is definitely a slowing from the third quarter. So the fourth quarter slower than the third quarter. Is the glass half full or half empty? I don't know, but eventually the listings volumes will return to the long-term averages, which are around about 5% of total stock of properties out there. And when that does, this stock is enormously leveraged to that. If you actually look at the top chart there, the red bars are the proportion of ads going into the most expensive premium listing. That proportion continues to grow, will continue to grow. And also, if you look at the bottom chart down there, the blue lines at the bottom are just showing you those residential display ads, just how they continue to drive the top line there. So when we do get a bounce in volumes with this stock, it will translate into a big earnings jump. So still happy for people to accumulate REA, and I don't think there'll be any negative surprises in the result. I think they'll pretty much match the market's expectation. And if for any reason they got sold off on the day, I would certainly be buying this stock. Moving on to the next one, SEEK is in a bit of a different category. They remain hostage to new job ad growth in Australia and China. Basically, Australia and China represent 90% of the business now. And the new job market in Australia has been slowing. That chart there shows you the week-on-week movement in job ads, and you see it's been sort of hovering around negative territory for the last few weeks. The federal elections that's looming has put a dampener on hiring intentions. And China represents more than 50% of revenues this year, so the lack of a US-China trade resolution is going to be a negative for them. However, if you do get a resolution, you should see a bounce there. The guidance for FY19 is for a 10 to 15% EBITDA uplift, and the underlying NPAT to be little changed. If there's any walk back from the guidance in the half year, you'd see a 10 to 15% pullback post-result. The domestic business is still growing, but is it growing enough to offset markets about China? I'm not entirely sure there. I think SEEK is more of a wait-and-see situation. Still like the story long-term, but short-term there's some headwinds running against them. Next one, car sales. This is the one that I've had on my best value idea in the sector for some time. I still think there's a lot more left in car sales. They're reporting low single-digit growth in new car volumes, and also 20k plus cars. Those are the categories of ads where they make most of their money. They have just increased their prices for the dealers by $2 per lead from February. And they've also had some gradual price rise for private advertisers. So clearly this company is confident about their dominant position in the market. Their main competitors, Cox Media, which owns the Auto Trader and Cars Guide names, are really struggling to gain any audience. I think the last month, Auto Trader, which is the big new challenger, had less than 2% of eyeballs, so not making an impression there. So that chart there just shows you the price rises they're jamming through. Those are the sort of the basic price rises. The finance business there in car sales still got a bit of a problem, but it's already factored into the share price. I'm very enthusiastic about the Korean and Latin American assets. They're going to play a greater role. I don't think this company's going to disappoint, and I do think this is one that people should continue to be adding to portfolios, even though we have had a bounce. Going on to next one, Domain Group there. It's the smaller cousin, if I can put it that way, of REA Group. The downside for Domain is that they are very, very leveraged to the Sydney market. They're very Sydney-centric, and particularly to premium residential, which is the epicentre of the residential market downturn. Sydney turnover has fallen more than any other capital. And to make matters worse, they've lost a bit of market share in Victoria in listings, which is probably the worst possible time to come for them. Also, we haven't seen how Nine Entertainment, the new major shareholder there, what their view is on strategy. Do they want to chase growth or income with this company? It's still too hard for me to work out what they really want to do. Stock's sort of getting closer to value, but it's really too hard for me to call. I think the half one NPAT forecast around about 22 million, probably likely to hit that number, but no confidence there that this one's ready for a turnaround. Sticking with the big caps, this is one that I have not spoken to about in the morning meeting. Iris, it's really a tale of two stories. The core financial markets business is very, very slow, sort of almost no growth at all. And really all of their growth has come out of the Xplan financial planning software in Australia and the UK. And 90% of their revenues are in fixed licenses. So when they report their results, I think it's highly likely they're going to meet the consensus numbers for FY19 for single-digit EPS growth. However, the companies continue to reinvest very aggressively, so I reckon there's some risk of disappointment on the outlook statement as they keep ramping up their reinvestment. The other big hard one to call on Iris is the impact of the Hayne Royal Commission on the financial planning industry. If the Hayne recommendations led to some contraction in the number of financial planners, it might be a negative for them. I do like Iris long term. I think it's a well-run company, but it does need to consolidate. It needs to be either a bid or a target to achieve its full potential. Good long-term stock there, but a lot of moving parts, and with the Hayne Royal Commission hanging around, hard to see the share price running off.